A rule change could force billions of dollars of stock to get sold this fall, and nobody voted on it. It's not a law, it's not the SEC, it's a company that just builds lists. That company is MSCI. They design the stock indexes that trillions of dollars in pension funds and ETFs quietly track. When MSCI puts a company on a list, those funds have to buy it. When MSCI takes one off, those funds have to sell. Not because they want to, because their own rules say so. Right now, MSCI is proposing to kick out what it calls non-operating companies. Here's the test. First, how it works. Step 1 asks one question. Do the assets you actually run your business with make up more than half of everything you own? Pass, and you're done. Fail, and you go to step 2. 5 financial ratios, covering operating assets, expenses, cash flow, fair value swings, and how much you lean on outside money to grow. Fail 4 of the 5, and you're out. Second, who it hits. MSCI ran a simulation across its global index. 3 companies failed outright. Michael Saylor's strategy, holding over 840,000 Bitcoin. Metaplanet in Tokyo, holding 43,000. And the one people keep skipping past. Yellow Cake, a London company that does nothing but buy and store uranium. No crypto at all. 3 more landed on a watch list. That's the tell. This isn't a crypto rule, it's a do you run a business rule. Third, why MSCI says it's doing this. Their argument is that stock indexes are supposed to track operating businesses, companies that make things, sell things, generate cash. If almost all of a company's value is just assets parked on the balance sheet, MSCI's position is that belongs in a commodity fund or a spot ETF, not in a broad stock index somebody's retirement account is tracking without ever being asked. Fourth, the counter-argument, because it's a real one. Strategy pushed back hard and publicly. Their line, digital assets are assets, and index providers should measure markets, not decide which assets a company is allowed to own. In an earlier letter, Saylor and CEO Fong Li called the approach arbitrary and discriminatory, pointing out that oil majors, REITs, and timber companies all pile their balance sheets into one asset class, and nobody kicks them out for it. Saylor's other point. Strategy issues securities, structures credit, runs a real software business. Funds don't do that. So what's actually on the table? JPMorgan analysts estimated an MSCI removal alone could force somewhere around $2 to $3 billion of mechanical selling. Closer to $9 billion if S&P and FTSE Russell copy the rule. That's the real story. Not one company. Precedent. And nothing is decided. Feedback closes September 30th. MSCI answers by mid-October, and any change would land in the November review. This is general education, not investment advice. But if you own an index fund, this is a rare look at who actually decides what ends up inside it. If that pulled back the curtain a little, drop a like and subscribe so the next one lands before the headline does.